Welcome back. You're watching Stockwatch with me, Simon Brown, and joining me to take your stock-related questions tonight, Roy Mutooni from Sanlam Investments, Alex Duys from Umthombo Wealth. Be sure to send your questions, email at stockwatch@bdtv.co.za, SMS 41392, or on X using hashtag Stockwatch. Gents, appreciate the time. Roy, let's start with you. The questions I got flying in. What excited banks so much today, and what did we make of the ABSA update, which came a minute after close?
I didn't actually look at the ABSA update yet, but it's quite clear that there's a trend line here from what the banks are saying, that times are actually not bad. The Black Friday was actually quite good for all of them. People are spending. There's a lot of transactions that went through, which was very good for NIR, and clearly people borrowed as well. So that bodes well for the whole festive season. I think that's positive. I think that's the underpin. Banks aren't expensive either. And all people, I think, have been waiting for was just that signal that the enthusiasm out there in the markets will be supported by bank earnings as well. And I think that's what we're going to see.
I mean, Alex, certainly, I like Roy's point about Black Friday. We've also, all this two-pot money, a lot of folks are saying they're going to pay down debt. I'm not sure if they will, but that'll help bank impairments. Alex, the banks certainly had a good day and aren't looking massively expensive.
Yes, good evening. Yeah, the bank certainly, in our view, is still relatively attractive. So obviously it was extremely cheap for 12, 18 months ago, but valuations are still compelling, especially if you can assume that its economic growth can perhaps get closer to 2% or above it. Then there is still potential to really grow advances. And because the banks do have quite a lot of capacity to actually extend loans if they have the appetite for it. So I think that's important to note. The banks also, most of them are very well covered, but also the books are under control when it comes from a credit loss perspective. You're not really out of control. ABSA is a little bit above the range, but if you look at today's guidance, they're telling you that there's clear improvements, actually better than anticipated a few months ago, and they expect further recovery going into next year and the year after. So that tells you that things are starting to pick up slowly but surely. And I think if the banks can continue to grow for the high single digits to low double digits earnings from this base, they still remain very compelling.
Take your point on that. The other question was the flip side of the equation. Platinum stocks, Northern, Anglo Platinum, Implats, all under pressure, all over 3% down per day. Alex, let's stay with you. I don't think anything massive happened except people didn't like platinum. Is there opportunity there, or is this really a case of first the metal must move, then we can buy the miners?
Very much that, to be honest, Simon. So if you can tell me where you think the PGM basket is going to be, I can tell you where your share price is. So I think that's the problem. Within the PGMs, however, I'm a bit more constructive on the platinum per se. I do think there is room for that to grow over time. It's had massive surpluses over the last decade. That's starting to move away. While obviously palladium and rhodium was very strong in the previous cycle, most likely will not be able to repeat that going forward. So that's what makes it difficult to understand from a basket perspective where they're going to go to. Then you get to stock specific, then it comes down to the fundamentals, right? So something like an Amplats, for example, is the best company in the sector, but it's got this overhang of all the shares that's going to be sold from Anglo American. So that's going to lead to short-term pressure and perhaps a very good entry point if you do believe in PGM cycles. So that's something to think about, but it's very difficult to really say where the cycle is going to go or where the bottom is. Usually this bottom takes longer than you think. You really need to see pain first. Are the balances under stress? At the moment, the balances are still looking good. Yes, the free cash is negative, but they can still sustain, year 2, 3, who knows how long.
Roy, have you got a crystal ball on PGM prices or thoughts? Because Alex is right. I mean, if we know where the metal's going, we can to get a sense on the miners.
I think you have to see a couple of things. First of all, you have to see capacity being taken out. You need to see mine closures. You need to see somebody coming out for a rights issue and contracting themselves, which will restrict supply and bring it closer to balancing with demand. Maybe it's also an announcement around what happens to Russian palladium supplies. So it's things like that that may be positive for these guys. But for as long as we don't have any of that, it's been a one-way bet. But there's a couple of things as well. when Anglo-Plat's shares were placed by Anglo-American, the demand was massive. I think it was multiple times oversubscribed there, and people didn't get everything they wanted. So it just goes to show you, there's lots of people looking and shopping for the bottom.
Yeah.
Like Alex said, that's probably your high-quality play, and that's probably why people want to get the shares, because they've been short supply, everything started rallying. So the bottom is somewhere soon. But like you say, it's next to impossible to pinpoint the exact turning point.
Yeah. No, I take your point. I always want to see metals move first, and then we can get excited. Roy, let's stay with you. Question coming through asking about 91. Why does it keep falling? Is there some value here in 91?
I'm not sure whether I should answer that question, but I'll go ahead. Think about yes, just for full disclosure, 91 was bidding to buy the company that employs me, Sim. So I'll keep this to the investment side. 91 is known as an emerging market play. They're an emerging market asset manager. Most of their assets are emerging markets, both South Africa and other emerging markets. And you've seen what's happened to emerging markets over the last few years. So clearly there's been outflows from there. And an asset manager does not like outflows because your fee base goes down as your costs are going up. So clearly, for as long as the dollar remains strong, emerging markets remain out of favor. It's going to be very difficult to attract assets into these into EM funds, and that's the lifeblood of 91. And I think that's been the difficulty. So that low share price, I mean, it's currently at a 52-week low, I think is a reflection of investors believing that emerging markets aren't coming back soon, and the dominance of the US and DM markets should continue over the short to medium term.
Take your point. Alex, you don't have anyone trying to buy you at the moment. Your views on 91, why it's been falling, if there's opportunity here?
Yeah, I agree with what Roy said. I think he summed it quite nicely. But you also want to buy these cyclical stocks when sentiment is negative towards them. You know, and 91 is the type of business where, but when I'm experiencing outflows like at the moment, I see it more as temporary or structural. A company like, for example, Coronation, I think it's got more structural issue when it comes to net flows, but 91, since it's got a magnificent global platform, it's got lots of growth opportunities. I think eventually it will start growing flows again, and then you can buy it at a potential price. Upside looks very, very good. If you look at the valuation of 91, pretty much any form of earnings growth from this base makes the share, in our view, very attractive. Now, I don't know when that will pivot. I mean, so earning at the moment, we're still seeing, you know, we sort of lost set of results. Earnings was down about 10%. But if you look at, you know, if you strip out the performance fees, about flat. That tells you this, they're running this ship as tightly as they can. And any sort of pivot when it comes to flows or market asset class prices, or perhaps favoring towards emerging markets, 91, I think, is very well positioned. But unfortunately, similar to some of the single commodity stocks we spoke about earlier, timing is very difficult to say. So you might have to be very patient, or in 6 months from now, stock could be up 30-40%. We don't know. And that's the difficulty when it comes to asset managers.
Yeah, I hear you on that. Question coming through about Naspers and Prosus. Alex, let's stay with you. The question simple: should I buy either or both of them?
Yeah, I mean, we like the Naspers Prosus stance in the stable. So we're starting at 10 cents. We think there is still lots of growth happening in there. And it comes to Prosus and Naspers, we saw a very good update from the e-commerce portfolio, and so it's finally starting to, stop the bleeding of some of the, outflows we've seen, cash flow outflows over the last few years, starting to produce some form of return. So we think Prosus and stable will do well. If you don't have any exposure, we'll always prefer to buy rather Prosus because it's more directly, in line to the assets. But if we really got exposure, for example, Naspers, don't take the tax knock by simply doing a switch. Just keep buying the Naspers, whatever the case might be. So, but I think either of the two for us was still attractive.
Roy, Prosus, Naspers, either, neither, both?
It's a Tencent story.
Yeah.
If you like Tencent, broadly speaking, if you like the outlook for Tencent, then it's definitely worth a look. Then the next step is this perpetual buyback gives you a bit of an underpin on share price, and that's for both of them. And then in Prosus's from Prosus's perspective, there's this new CEO who's trying to turn around the e-commerce portfolio to turn it from loss-making bets to profitable bets that they can actually sell and to generate value. Remember, they're being incentivized now on this moonshot of I don't know how many billions of market cap they should attain in over the medium term. So there is an underpin to value there from Tencent. There is an incentive for management to deliver. And in truth, for a South African investor, I suppose Naspers is probably more accessible. If you're an international investor, you probably prefer Prosus because of its primary listing in the Netherlands. But in truth, for us, it's much of a muchness.
Yeah, no, I take you. Question coming through around Caxton. The writer says, held it for 14 years. What's that? About 2010. Not happy, wondering if they should sell. Your take on Caxton?
I'm not very close to Caxton, to be honest, so maybe I shouldn't comment.
Okay. No, fair shot.
Comment on it,
Alex, Caxton, any closer?
Yes, I mean, we are material shareholders in Caxton, so I'm actually very bullish on the business. So yes, unfortunately for the viewer, it's been a disappointment over the last 14 years, but I do think things have changed. So if you look at the Caxton valuation, they own obviously a stake in Impact, which is also listed, a bunch of cash, and obviously still got a printing and stationery business and so forth. So if you just take the market cap of Impact and cash, it pretty much almost valued the core business at not much. And we think the probability of a deal happening in Impact is quite high, especially now since that legal proceedings has gone in their favor.
Yeah.
And they only need to buy another 16 or so % to get control of Impact, and they can consolidate it, they can make changes, and it will make it, and the business will be much more worth, and we think that will create some value. The banks will also be much less lazy. So I still think there is substantial upside, but you're awaiting corporate action for that to be unlocked. So that is the risk. But I do think, I just want to highlight again, I think the probability of corporate action, in our view, has increased over the last few months. So that is why we are constructive.
Yeah, no, and yeah, absolutely. They're winning the corporate, the legal side of it, which kind of opens them up there. Quickly before we go to break, Alex, AECI, which David Shapiro always calls the bang bang stock. The question is this a good looking investment from your perspective?
Sure. It's a difficult one because the new management team has got a very, very ambitious turnaround strategy there and looking to divest from businesses and still got very high targets when it comes to EBITDA they're going to achieve and so forth. I think it's going to be difficult for them to achieve them. I don't like the fact that they're going to bring in consultants to assist them with try to do turnarounds. I like rather to have actual management implement those type of stuff. So for me, it's a bit of a wait and see. I mean, some of the consensus or brokers were very, very bullish on the stock and they've downgraded them substantially. So I think there is room for disappointment. But saying that, if they can execute, there is substantial upside in the business. So certainly worth a look, but be cognizant the risks are quite high at the moment.
Roy, AECI, thoughts on that? I mean, it's certainly, there's risk there. Is there potential, I suppose?
So the thing is, there was a lot of optimism when those new management came in and then they put together their plan. And the first thing they said was disposing of a couple of assets and restructuring. But when you look closely at their restructuring plan and the targets they set themselves, it's quite a stretch. And it's difficult to provide the credence that they'll actually be able to achieve it. I think that management team needs to put some runs on the board. They need to build confidence and they need to start delivering on, first of all, the disposals and a few restructuring things that are visible before the market gives them credit for it. I think their goals are stretch goals, that's for sure. A little bit optimistic, but that's never a bad thing. It's just that I think the market has been disappointed by this business over the medium term. So we just need to see a few wins before getting a little bit more comfortable with it.
Yeah, I like that. We need some wins first. Roy, let's stay with you. Pan-African, held it for a while. Should I continue to hold, or is it perhaps time to take some profits?
That's a gold price call. Look, I think you have to split it into two ways. First of all, as an operation, very well run. The guys have developed their minds. You're going to see rising production over the next few years. And if that's into a rising gold price and a weakening rand, then you've got the nexus of a winner. But clearly, the variable is the gold price. The gold price, people are forecasting that will get to 3,000, hasn't quite gotten there, has gone a bit sideways, probably is coming off a little. Look, nobody ever got hurt by taking profits, and this stock has rallied.
Yeah.
I think it's up more than 100% over the past year. You've done really well. Take some money off the table, nothing really hurts. But the short to medium term outlook for the business is solid. Solid management team, good production profile, low cost production, nothing really wrong with them operationally.
Alex, your taste on PanAv. They announced that deal recently in Northern Australia. I think it's 1,500 kilometers from Darwin, which in of itself is already nowhere. A good management team, would you be holding or taking some profits on Pan-African?
Yeah, we've seen a couple of deals now in the gold sector, which is usually an indication that perhaps at the top of the cycle, but due to the geopolitical risks we've got, perhaps not. But that's something to be cognizant about. Just back to Pan, I mean, they got roughly about 40% increase in production, if I'm not mistaken. Yeah. So that is quite a sizable investment there. And I think that's my concern with the gold counties, that when you have an upcycle like we have now, they're all investing all new supply. We're not getting the dividends. And that's the same with DRD. You could argue the same with Goldfields, and Sibanye, of course, is in a disarray. So that's the problem with the sector. So you pretty much have to hope that the gold price in rand terms continue to increase so you can make further returns. And that is a problem. So, if you are constructive gold, then yes, continue to hold these businesses. But if you are overexposed and, then that perhaps could be a problem. For example, something like the DRD is busy with very, very substantial projects, and they don't have lots of margin of safety. So if the gold price, for example, comes down 10%, then all of a sudden they swing into negative free cash.
Yeah.
I'm not exactly sure for Pan-African the numbers are, but they are quite geared, and but I like the business. I think from a mid-tier miners perspective, it's very, very good. But be cognizant of your exposure, and don't try to chase something which is run off incredibly hard if you don't believe it can continue to be the case.
Yeah, if it's run hard, what runs it harder? I take your point 100%. Alex, let's stay with you. Question coming through: what's the best Trump trade for 2025, or has that boat sailed?
Sure. Okay. So I think a very important day would be when he actually gets into office, because he will sign a lot of executive orders. We'll get a sense of where we are. I mean, he's going to sign a lot. I think probably a record. Look, I think he'll probably be good, bad for oil. I think oil prices will probably come down. Lots of new supply is going to come on the market in the US. So I would imagine something like a Sasol, perhaps not ideal in that type of situation. But if Trump achieves his promises, for example, ending the war in Ukraine, Russia, which he said he will do in one day, see if that happens, then obviously that could mean that the overall risk premium comes down in the global markets, and that could see a bit of a spike or rally in some shares. So perhaps once again, gold, perhaps not ideal in such a scenario, but it's difficult to pinpoint shares in South Africa, I would say, that will necessarily benefit. There are, of course, other risks that will come down the line, like AGOA and so forth, and these views on China, which is a risk to us. So I think from a global perspective, there's perhaps a few options to play. Locally, not that much.
Roy, a Trump trade for I mean, he's in 20 January, but he's already issuing dictates so that they're not legal yet.
Look, the biggest Trump trade has been Bitcoin, hasn't it?
Yes.
So far, but most of that is probably behind us. I mean, you can never call that one. But I think Alex has the right approach. It's about the stuff that his whole platform is on. So militarization will probably go backwards. That's one thing, which really grew during the Democrats. So you probably will not want to be in military stocks. That's one. Energy, definitely, because of production of oil and production of gas, you probably want to avoid that. But the biggest thing, I think, is that if he gets the Ukraine war finished and focuses on the US and total, the risk premium falls, then it's very good for the rest of us. It's very good for the rest of the world, and you can invest in emerging markets, and the South Africa bond yields will come down if that happens. The problem is that what we're looking at right now is his policies are probably going to go the other way and increase interest rates in the US because inflation rises. So that's a problem for us. So I think it's very binary. It's very important to see what he actually does on the first day. And Yeah, and that I think is the only time that you'll actually know for sure, as unpredictable as he is.
Yeah, we need to start signing some of those orders. Roy, let's stay with you. Question coming through. Luxury, is Richmond the best? Is Richmond good enough, or are there better options I should look at offshore?
Through the cycle, Richmond probably does better than most for a couple of reasons. First of all, it's nicely blended between China, Europe, and the US. What's bringing it down right now is its exposure to the Chinese consumer who's struggling. So that's why from an earnings perspective, it probably looks a little bit weak. In addition, it's coming off a very high base, having done well over the past 3 years post-COVID. So there's nothing wrong with Richmond. I think it's a reflection of the negativity around China. Outside of Richmond, LVMH is down about 15%, nicely diversified, probably touches into things that aren't even luxury. But a nice focused one is probably Prada, which is listed in Hong Kong. They've just gone through a big restructuring. They focused themselves on 2 brands, and they're growing their volumes really relatively well. The valuation levels were quite low. So that probably gives you a little bit of margin of safety, as much as you can get in luxury. So those, I think, yeah, that would be the one that I would look at in the luxury goods sector for the time being.
Alex, Richmond or prefer something offshore, or perhaps no luxury for you?
Look, I mean, luxury is cyclical, so I think that's important to note. So when we do see down cycles like we experience at the moment, that is natural. But these companies are all well positioned. You know, balance sheets are strong, cash generation is excellent. Obviously got brands which are irreplaceable, right? So you'd like to buy these companies when sentiment is negative towards them, and then hold them for a extended period of time as the cycle turns in their favor. Now, one thing I do want to highlight is that we've had unprecedented market strength over the last 16 years due to monetary easing and very high aggressive fiscal measures. Now, if there's a bit of a slowdown in that, asset class prices does come under pressure. Also, for example, let's say Bitcoin comes down because it's such a big market these days, then people's wealth will feel less, and they'll tend to spend less on luxury goods. Because, I mean, this is not salary type of people that buy these products. It's people that's got assets.
Yeah. So
asset class prices are very, very important. We strong markets. So I think there is due for some, call it meandering market prices, perhaps a pullback in certain areas. And that's why the stocks are there. But if you're willing to buy and hold, look to buy on weakness. I think something like a Richmond is still very well positioned. It remains a world-class business. Balance sheets are as strong as houses. It's just about, perhaps start buying now if you want to get exposure and increase as time goes on. Don't try to buy all at one stage, because it could always be better entry points.
Yeah, but I love that. Richmond buyers are not salary earners. 100%. That sums them up. Let's go to some stock picks. Alex, you're going with Tiger Brands. Results out 2 days ago. Some pressure, but the turnaround perhaps gaining some steam, and certainly your stock pick this evening.
Yeah, certainly for me. I mean, I've been in market for about 16 years, and every single time the presentation at Tigers has been quite a somber affair. But, yesterday I actually walked away very, very positive. It's clear that the management team are starting to gain traction. They've made enormous strides just in the last 6 months. And Tigers is this big behemoth that it's still going to be slow to turn. But when you turn it, the upside potential, I think, is quite immense. So they are talking about volume growth, which is almost unheard of over the last decade.
Yeah.
They're talking about efficiency gains, reducing complexity, cash generation being a lot better. All of these metrics are taking the right direction. And remember, the balance sheet is also very strong. I mean, net cash position. They're not like a Pick and Pay where you're trying to do a turnaround with one hand tied to your back. Yeah, they've got all potential options available to try to do the turnaround. They're going to spend a lot of money on building new bakery and investing where they need to be. They've cut costs with management where necessary. I think the management team is on the right track. It's still early days. There still need lots to be done. But if they can execute, I still think there's substantial upside in the business over the medium term.
Roy, Telkom, you had some questions around Telkom. One is there another offer coming for Telkom? Don't know about that, but certainly your pick for today, keeping it local with both of our picks.
Yeah, absolutely. So Telkom always has this cloud over it, government influence, landlines and legacy systems and stuff. But I've observed the company over the past few months. And first of all, management's confidence has increased immensely. They're no longer a target. For them, I think corporate action has ended. They've sold their SwiftNet business, which was very capital intensive. It means that they're probably going to start generating cash. When that cash comes in from the sale, their balance sheet will be relatively clean, pretty lazy, allows them to do a lot of other stuff. They've got the biggest fiber network in the country already installed, and they're passing more and more homes and installing. I think the installation capacity is about, I think they install in 1 in every 2 homes they pass. So this is a business that's well positioned. And when it's going up against Vodacom and MTN, and it's growing service revenue by about 13%, 13% per annum, compared to these other guys who are growing Vodacom at 1 or 2%, MTN at 3 or 4%, it shows you that they've got this embedded competitive advantage that they keep driving home. So it's had a little bit of a rally, but in my mind, it's still cheap, and there's a whole lot more to come from that.
Yeah, and it hasn't got the challenges the other telcos have into the rest of the continent north of us. We'll leave it there. That's all for tonight's Stock Watch. Thanks to my guest, Roy Mutooni from Sanlam Investments, going with Telkom. Alex Duys, Umthombo Wealth, going with Tiger Brands. Up next, the close. Stay tuned.
Thank you.